program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we want to tell investors about flex options. Flex options aren't new to the listed options business, but many investors have heard of flex options but aren't sure what they are. Flex options are customized options that trade on one of the exchanges, not over the counter. The number of contracts to trade is usually quite large, as the customer buying the option usually has a very specific need in terms of contract size and expiration date. As I mentioned, flex options are customized in terms of expiration date and number of contracts. The auction process occurs just like any other option trade. The difference is market makers have a specific amount of time to respond with a price from a buyer's inquiry for the customized option they seek to buy. Once time expires, the participants either agree on a price and make the trade, or if no meeting of the mind occurs on price, no trade takes place. Flex options can be traded on any listed product. So if you want to learn more about the flex option, feel free to call Investor Services at 1-888-OPTIONS or reach them at their website at optionseducation.org.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Marty Kearney from the Chicago Board Options Exchange. Welcome, Marty.
Hey, Joe. How you doing?
Doing great. Thanks so much for taking time to join us today.
I'm delighted to.
Well, before we get into the strategy that you've chosen to talk about for our listeners, let's talk a little bit about your journey into and through this industry.
Okay. Well, I started out with an interest in options. I had friends that were traders at the CME, Chicago Board of Trade, Chicago Stock Exchange, and the CBOE, being a Chicago person. And in a former life, Joe, I actually had a real job, worked for a real company. I was buying a stock in the employee stock ownership plan called an ESOP. And I had about 1,800 shares of stock, and I started out by selling 5 call options against it. So I did the covered call strategy. And the options expired, and I thought, this is just the greatest thing since sliced bread or, the convertible with air conditioning. And I thought, I have to learn about these strategies. And the next one was, well, I don't have enough money to go buy a stock and do the covered call. So I actually did a bullish call vertical spread, which is kind of a piece of the little strategy we're going to talk about today. So that got me started. I came down in late 1980, early 1981.
Came down where?
To the Chicago Board Options Exchange, started trading my own money. I started out by putting $5,000 in my account, believe it or not, which you have to do a little bit more than that these days.
But that was a lot of money back then.
Back then it was a lot of money for me, that's for sure. And I started out trading very small, and I traded full-time for 12 years and part-time for 4 years.
As a market maker?
As a market maker, trading my own money. And for that next 4 years, I was just on and off the floor, basically to keep my registration current, so I didn't have to take all the tests again. But I started a little securities firm. It's still around. It's doing well. And but at that point in time, I was lured back by the Chicago Board Options Exchange and Business Development. And I'm now in the Options Institute, the educational arm of the CBOE, and we work very closely with our friends here at OIC and their education department as well. So I've been an individual investor. I've been a market maker on the floor. I've pretty much run my own firm, and now I work for the exchange. So my options knowledge is pretty deep. You get off of the options area into other different types of asset classes. It's kind of weak, but the options area I think I know pretty well.
Well, we're thrilled to have you here today. Tell me a little bit about the Options Institute. As you said, great friends
right
over there. You work closely with us here at the OIC. Tell us about some of the things you're doing and some of the people you work with there at the Options Institute.
Sure. We're set up pretty similar to the way the OIC is with an educational department that we're kind of separate. And in my group, there's 4 of us. Jim Bittman, Russell Rhodes, Peter Lusk, myself, all with lots of years of experience, either floor trading or doing other things in the options industry. And we get out and talk to individual investors. We talk to institutional firms. We talk to hedge funds. We'll pretty much talk to anybody about anything having to do with options. And it's always been my contention that we need to make the consumer better educated. If they're better educated, I'm happy because they're coming back. Instead of trading 5 XYZ calls, maybe next month they'll trade 10. Okay, and I think the education that our group and your group have done helps tremendously. It absolutely helps get the message out, and there's so much good information out there. And your site especially, I happen to like on the educational arm. So we work kind of hand in hand, and some things we will actually do for you. I just did a talk out in, I believe it was in Texas for the OIC. So we have our instructors will go out and do, a portion of the OIC talks. So we work very closely with OIC.
Yeah, and the fellows who you mentioned, colleagues of yours do a great job.
Yeah, absolutely.
Well, before we get into today's strategy, it is a really big year for the CBOE when we talk about history of the industry. Why don't you tell our listeners a little bit?
Absolutely. Well, we're taping this on the week that is the 40th anniversary of options, and options started in the old smoking room at the Chicago Board of Trade with 16 stocks, calls only. This is 40 years ago this week.
What was that? Calls only?
Calls only, no puts.
Yes. Okay.
Puts didn't start coming in for about another 4 or 5 years, and it was a pilot basis, and as most pilots do in this industry, if it works out well, they're here to stay. But
you hear that, listeners? Calls only.
Calls only. First day we traded 911 contracts. So, but obviously it's grown a lot since then, and 20 years ago we started trading, or 30 years ago we started trading index options, and 20 years ago we started doing the methodology for VIX, the volatility instrument. And you guys have an anniversary too, don't you?
We do. We just, we were founded in '92, so just surpassed our 20th year here.
Yeah. So the CBOE's been around, and the other exchanges do a good job in the education as well, but especially the OIC that we're here with today.
And I think, as you said, same week we were within a day of the actual 40th anniversary. I think it was April 26th.
Yeah, absolutely. So it's a good little milestone, and we've been digging out pictures and getting stories from people, and we have them on our website. So people can go to cboe.com if they want to track this stuff down. So it's nice.
That's great. Well, why don't we roll into our strategy? We reached out to you and said, Marty, what strategy would you like to talk to the retail investor about? And your response was?
I think the butterfly is an interesting strategy. Now, the downside of the butterfly, because there's always good and bad, right? The downside of the butterfly is, Joe, that it can be a little commission intensive. And, to get in and get out. And once we explain it, I think our listeners will find out why. Also, you have to be pretty precise on where we're going and when we're going to get there. So you don't have to be exactly right. But I think it's a very good risk reward typically on the butterfly, where you can put a position on for a very small amount, and percentage-wise you can do pretty well. Now, the gain is not unlimited. There's a limited amount you can make, but there's also a limited amount you can lose with the butterfly.
Well, let's why don't we start by laying out exactly what a butterfly is for those listeners who just have heard of it, but
Right. And this is a great industry, as you know, for strange names.
Indeed.
For strategies. And if people know, like buying a call and selling a put, when you get involved in these exotic sounding instruments like the butterfly, it's probably just a combination of two very basic strategies. And that's exactly what the butterfly is. So the butterfly is basically a bullish, and I'm going to stick with calls, and we could do this with puts as well. But it would be a bullish call debit spread and a bearish call credit spread. Or you could do a debit spread and a credit spread with puts. But the butterfly, we're doing all calls or we're doing all puts.
Okay. And how many contracts?
Well, the nice thing about the butterfly is that what we're actually talking about is a 1-to-1 to 1-to-1 ratio. So we're not short any contracts. I don't want to be short, but I'm not actually net long any contracts either.
Okay.
And with a butterfly, the legs are equidistant. So if I'm doing a 5-point bullish call vertical spread, I'm doing a 5-point credit spread. Or I could do a 10-point and a 10-point. But when you think about this, the butterflies are very pretty. They're very symmetrical, okay, as they fly through the air, okay, and that's exactly what we have, right? We have a call spread, a debit call spread, and a credit call spread rolled into one.
So talk to me about that sweet spot where the investor's, going to make money versus losing money.
Yeah, let's just take a stock trading at $70.
How about XYZ?
Let's use XYZ, one of my all-time favorites.
Me too.
Okay, so XYZ is trading at $70 per share, okay? And with the stock trading at 70, what I'd like to do is, I think my target on the stock is $80 per share, okay?
Over what period of time?
Usually I don't go out more than about 2 months. So maybe a month, month and a half, 2 months. And actually there are some products like the ETFs like the SPY, you might even be able to do this with a much shorter, even a couple week time frame. But I don't want to go out more than 2 months.
Okay.
I want to keep it short.
So we've got a $70 stock that we think is going to have a pretty good run in the next few months.
Yeah, I think it's going to head to $80 per share, okay? So what I'd like to do is, rather than buy that 70 strike price call, maybe it's trading for 5 points. I'm just making up these numbers as we're going along here.
Okay.
And if I'm right and we go to 80, I could make 5 points, couldn't I? Because the 70 call would be worth 10, cost me 5 to initiate it, I made $5. But maybe there's a cheaper way to do that.
Yeah, because you're risking 5 there.
I'm risking 5 to make 5. Now, obviously, if it goes above 80, I could make more than 5.
Right.
Okay. But that's my target price. So I'd like to, how do I target $80 and put the least amount of money up? I think as a trader, that was always what I was looking for. What's the most economical way for me to initiate a trade?
Exactly. It's not just about making money or sometimes losing,
Correct.
But it's doing it most
Correct.
efficiently.
Right. And not only that, when we're talking about buying that 70 call for 5 points with the stock at 70, the stock would have to be to $75 to break me even.
Yeah.
Okay. So what I might do is this. So the stock is at 70. I think we're going to 80. Why don't I buy the 75-80 call spread?
So that's the debit spread you were talking about.
That's the debit spread. So I have the right to buy the stock at 75. I have an obligation to sell it at 80. Okay? And let's just use round numbers through this whole thing so people don't have to pull over in the car and take out their pen and write down the answers, right? So I'm going to buy the 75-80 call vertical spread for 2 points.
All right.
But I don't think we're going above 80. So here's what I'm going to do. I'm going to sell the 80 call again and buy the 85 call. And let's say I bring in $1. So here's what I have, Joe. I own the 75-80 call spread. Own the 75. I'm short an 80.
You paid $2 for that.
Paid $2 for that. And I sold a second 80 call, bought an 85 call, and I brought in a $1 credit. So I put this whole package together for $1. So I'm risking $1 on this trade. So this is where you have to think, okay, where do I make money on this deal?
Good question.
Okay. It's always you have to know a couple of things. One, what's my break-even point? What am I risking? What can I make? The risk is easy. I put this position on for 1 point. No matter where XYZ goes, that's the most I can lose. Okay? So the second thing is the break-evens. Because I own the 75 call and I put this whole package on for $1, my first break-even is 76.
And how do you get 76?
Well, because I own the 75 call.
Okay.
And I spent $1 out of my pocket.
I got it.
Right. And that dollar, as everybody that's listening knows, that's per share. Each contract represents 100 shares. So I'm risking $100 to initiate this trade.
So it's going to be that long strike plus the debit paid.
The long strike, the 75 plus the $1 net debit paid. Correct.
Okay.
And I'm excluding transaction costs.
Sure.
And as we said, as we get into this, you'll see that the transaction costs are a little bit of a drag on the return here. But when you see the risk reward, it's not so bad. Okay.
Very good.
Now, I'm going to talk about the second break-even point in a moment, but let's talk about what we can make on this trade. Let's say that this stock goes to exactly $80 at expiration. What happens here? The 75 call is $5 in the money. My two 80 calls that I have sold expire worthless. The 85 call I bought as my insurance policy expired worthless. A $5 spread, but remember it cost me $1, so I don't have $5 profit here. I have $4 of potential profit if we land right at 80.
That's still a home run.
That's still a home run. So I risked 1 to make 4. And you'll find a lot of time, the butterfly will cost you money. You can't put a butterfly on for credit. At least, if you put on all 4 legs at the same time. Okay, it will cost you money. But there are many times where the butterfly will be even less than $1.
Good.
I could put on a 5-point butterfly for 50 cents. Now I'm risking 1 to make 9.
Right.
Okay. The second break-even point is, let's just say the stock heads above 80. Okay. I was bullish on the stock. It did a little bit better than I thought it would. My second break-even point actually is 84. Now, this isn't real complicated. At 84, the $75 call is $9. It's $9 in the money. Okay. And the 280 calls are $4 in the money each against me. That's -8. And remember, it cost me $1 to initiate the trade.
Right.
So anywhere between 76 and 84, I make money. Now, above 84, yeah, I'm long a 75 call, but I'm short 2 of the 80s. So all the way up to 85, I'm giving money back. Anything above 85, the most I can lose is $1. Everything goes in the money. I initiated this trade for $1 debit, and unfortunately, I lost $1.
Well,
okay.
Really crystal clear explanation. That's dynamite. Let me. Now that was a butterfly with $5 strike increments. You can do these butterflies with different strike increments, correct?
That's correct. We could have done. If my target was 100, we could have bought the 90-100 bullish call debit spread and sold the 100-110 bearish call credit spread. Okay, but a butterfly is, just by definition, the sides are equidistant. They're either 5-point or 10-point or whatever increments. We're going to put it on for a debit. And you know what's interesting about the butterfly, Joe? When I'm out on the road doing things for the CBOE or the OIC, I sometimes ask audience members, okay, is something like the butterfly, is it bullish, is it bearish, or is it neutral? And I get a lot of people saying, well, it's a neutral trade. It could be any of the three.
And why is that?
Well, in this particular case, the stock's at 70. I think we're going to 80. So I would do, a call spread out of the money. And, I would target, my two short options are the 80 strike price.
That sounds like the key.
Yeah, absolutely.
Those short option strike is your target for the underlying at expiration.
Absolutely. So you could be, if you're bullish with the stock at 70, I might do the 75, 80, 85 butterfly. I'm long 2 contracts, I'm short 2 contracts, but the short 2 are the 80 strike price. If we're at 70 and I'm bearish, I think we're going to $60 a share. Maybe I'm doing the 65, 60, 55 put butterfly. Once again, targeting the dollar level that I think this particular stock is going to.
That's a great point. I hope our listeners have that. So the butterfly strategy can be neutral, bullish, or bearish.
Absolutely. Absolutely. And I am a big fan of the butterfly. One of the things because I can see the words coming out of your mouth right now. One of the additional downsides of the butterfly is something that investors should be aware of. Let's just, for example, go back to the stock lands exactly at $80. Okay, I put up a buck. That 75-80 call spread is worth 5 points, isn't it?
Sure is.
But if we land right at 80, and today's expiration Friday, what's going to happen? My broker will automatically exercise my 75 call for me, and all the other calls expire worthless. And Monday morning, I'm coming in long 100 shares of stock. So what you have to remember is, and pick a number, okay? If we're trading at 78, okay, I'm going to be long 100 shares of stock. If we close at 82, my 75 call is $7 in the money, but I'm short 2 of the 80 calls. I'm going to be short 100 shares.
So there has to be some proactive management at expiration, depending on where that stock goes out.
Absolutely. Now, if the stock just goes to the moon, I'm pretty well all set. Everything's going to be exercised, and I expect to be assigned. If the stock, heads down from here, you know what? Everything expires. It's not a big concern. But if we're anywhere near 75 to 85, I have to decide, what do I want this position to look like next Monday after expiration? And if you do not want a stock position, I suggest getting out of one or both of the spreads so that we are minimizing our stock risk for next week.
Okay, good point. One of our favorite Greeks that we frequently talk about is implied volatility. Does implied come into play with the butterfly strategy?
Implied volatility comes in a little bit. In this particular case, I would probably be slightly delta long, meaning that if the stock were to move up a point, that the butterfly would be working for me ever so slightly. But because I'm long 2 options and I'm short 2 options, at least the delta doesn't have that much of an effect. I get a little bit longer. The closer to expiration I get, the short 80 calls, provided that we're still at 80 or lower, they'll start to lose the whole time premium and everything else, and I'll get delta longer. So I've got theta against me because I'm putting this position on for $1 debit. But once again, it's a very small theta. It's only $1.
Right.
Okay. I've got a slight delta advantage to me. If volatility goes higher, it's going to be close, but I would think it might be a very, very slight negative. It's almost zero.
Okay.
Okay. Interest rates don't have any great effect. It's a very short-term instrument that I'm putting on. It's something 45 days or less.
So really dynamite risk reward. Your stock price at expiration is the strike you want to be short.
Correct.
Really a couple of the keys to this strategy that really is a good one for retail investors.
I think it's an interesting one. Professionals put this on all the time, and the reason they would put this on is that, let's go back to me on the trading floor, and one of our listeners here decides to buy some 80 calls. They buy 10 of the 80 calls. Okay, so I sell on the calls, and I don't quite know what I want to do to hedge myself as a floor trader. I might buy 5 of the 75s, 5 of the 85s, and I just legged into the butterfly. Mm-hmm. Okay, so but investors have to keep that commission thing in mind, because when I talk to investors about the butterfly, I say basically we're trading 4 contracts in, and that's only if we put the butterfly on one time. Mm-hmm. Okay. Now, most brokerage firms either have a flat fee for the number of contracts, or they set it up with 2 tickets perhaps. It could be a 2 different spreads. It's not 4 ticket charges. It might be 2 or 1 or 0 ticket charges, depending on what brokerage firm they're with. But I tell people, plan ahead to have 4 commissions on the way in and 2 on the way out. Now, maybe you don't have to close anything out, but you might have to. So have a realistic expectation of what the commissions might look like on this particular trade.
Excellent, Marty. Did a heck of a job going through that. Before we wrap, as a wonderful old floor guy, you got a little story for our listeners? I oftentimes like to ask our guests to, offer an entertaining story.
Well, I've got one butterfly story, and I was at the Options Institute, and our software is, at least the software they let us use for free is not very good, okay, because we're pretty cheap when it gets down to it, right? And this is being taped, so I better be careful what I say.
You better.
But I went over to a friend's little shop. He had a specialist firm on my trading floor. We call it the designated primary market maker. And I was looking at a butterfly, all right? And I remember the particular stock, but I'm looking at the butterfly, and I'm looking up some real prices. We have to use real prices in our examples when we use stocks, not like XYZ. But I start humming Butterflies Are Free. This was an old song from, 40, 50 years ago. Most of your listeners probably have never heard of it. And don't go look it up on YouTube because it's a terrible song. But I'm singing Butterflies Are Free, and the people that are up having lunch for this specialist firm are now all standing behind me. And one of them, an ex-football player, whacks me in the arm and says, "Where's the butterfly for free? Turn it over to us." We can't see it on the screen. And think about that. If I could risk 0 to make 5, how many times do you think I would put that on as a trader?
About position limit.
Position limit. What is it, 200,000 contracts or whatever on this particular stock? And I said, of course, well, you can't put a butterfly on for free. And so they said, well, you've worn out your welcome. Finish what you're doing and get out of here. Okay, so they threw me out of the office, which was fine because I was being pretty obnoxious at the time. But butterflies are a very good risk reward. They are commission intensive. And if you're doing it with a stock or an ETF, be aware that even if it's working for you, what will happen at expiration, and is there action I need to take to close either the debit side or the credit side or both so that I don't end up with an unwanted stock position?
Marty, great advice. Thanks again for joining us today.
Oh, I'm glad to be here. Thank you.
And we'll see you out on the road.
Okay.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Patty Schuler. Patty's Vice President of Sales, Marketing, and Business Development at the Box Exchange. Hi, Patty.
Hey, Joe. Thanks for having me on today. I really appreciate it.
My pleasure. Well, it's an opportunity for our listeners to find out about you as well as the Box Exchange. So why don't we start by you offering a little bit of your background in the industry and maybe tell us when you joined the Box and what you're doing at the Box.
Sure. So I actually started in this business as a runner on the CBOE trading floor back in 19. Yeah, there aren't any runners anymore. So that was actually in 1986, and I remember the first day of my position or my job was actually when the city of Chicago had a ticker tape parade for the Chicago Bears because they had just won the Super Bowl. So definitely feeling like I'm dating myself from that standpoint.
But you did go to work. You showed up.
I did go to work. I did. Absolutely.
Did you work the whole day?
The entire day.
Oh, geez. Okay. Well,
so anyways, I worked, my way up with various positions on the floor of the CBOE, from runner to crowd clerk to working on the institutional trading desk, and eventually found my way into management in charge of running trading floor operations on the CBOE, the Amex, the P-Coast, and the Philly for a large clearing firm.
That's a big position.
Yes, that job was actually a really interesting and really broadened my horizons in the options business and being able to form those relationships on those other options trading floors really, furthered my career in that respect. And then, we actually did stock layoff and option layoff when I worked at those firms. So,
and for our listeners who may not know what that is, what is stock layoff?
So the large clearing firm, we obviously had several hundred market makers that cleared through us, And back then, the only way to enter option orders as well as stock orders was through a desk. They actually had to call us with their orders, and we had to enter them into the marketplace.
It was the good old days.
The good old days. Unlike now where market makers just, everything is done automatically and electronically, and they're kind of on autopilot from the hedging standpoint of their positions.
Mm-hmm.
So with that, I eventually came to work for CBOE in 2004 to help them out with business development and strategic initiatives. And I started with Box in 2011 and have been working on business development initiatives here. So given my experience and actually time frame in this business, I've seen a lot of market structure changes and the way business gets transacted compared to when I first started. It's all good, but the level of complexity obviously has increased from 1986 to 2013.
It sure has, but I think that complexity, most of which is behind the scenes, has made the environment just remarkably good for the retail investor.
Absolutely. It is way more efficient, and the retail investor has way more opportunities to be able to transact business in the market. Whereas before, they would call their broker and not maybe know what happened to their order for either hours or even, the next day. So definitely the retail broker is at an advantage with, the way things are nowadays from a trading standpoint.
Now, tell me a little bit about, the team you work with over there at Box. And so why don't we start with that?
Right. So, Box is a small exchange. We have about 27 employees. So we're pretty small.
Very efficient.
We are. We run very lean and very efficient. We're not like one of the bigger exchanges with several hundred people that are employed by them. But, because of that, we are all pretty flexible in our knowledge of the business, and some of us definitely have multiple hats that we wear on a daily basis. From that standpoint, we are constantly running new ideas by each other and asking each other for opinions. We try to keep each other in the loop at all times. From a communication standpoint, we keep each other in the loop, whereas, if you work for a larger firm, that might not always be the case. You kind of work with your core team and don't really touch the other areas of the business.
Now, you've got 27 over there at the Box. How many of the 27 do you work with on a fairly regular basis?
I would say that there's about 5-6 of us that are the core group here at Box. That's the business development and sales. There's 2 of us, and our CIO and our CFO and our chief legal officer. We're constantly dealing with on a regular daily basis, multiple times a day, and our development team.
Right.
Which I'll get a little bit into that. Maybe I know you're going to ask me another question, so.
I have more than one more question for you, I assure you. I notice, I know that the Box is jointly owned by the TMX, the Toronto Exchange, as well as 7 broker-dealers. Does that impact you in any way?
Yeah, sure. So we are majority owned by the Toronto-Montreal Exchange and the 7 broker-dealers, as you mentioned. From a technology standpoint, all of our development is done out of Montreal. So we rely on that team up there to develop whatever technology we're going to be implementing on the exchange. They're a great team to work with. They definitely understand U.S. options market structure, so it does help in that regard. we just undertook a big project over the last year and a half, and they sailed through it and were able to help us get it launched, which I'll talk about after a little while. But as for the 7 broker-dealers that own us, we don't really see too much of an impact from them, whether that's from an order flow standpoint or a decision-making standpoint. They generally kind of it's business as usual with them.
Well, that's good. Sounds like good synergy.
Yeah, definitely.
Before we move on to some other ideas, you mentioned this year-and-a-half project. Why don't you tell our listeners about that?
Right. So we just launched our complex order book.
Order book. Okay.
Mm-hmm. So this past Friday. And the complex order book allows users to be able to send spreads into the exchange. So that had been an intense year-and-a-half project of just confirming development and doing QA and testing. And we had actually anticipated to launch the book by last year, 2012, but we got hung up on the regulatory side and had to wait for the SEC to approve our rules.
That's unusual.
Yeah. Very unusual.
Okay.
So we're really excited about the complex order book. It's something that we've been working on, obviously, for the last year, and we are going to be complete with the rollout of the entire universe of names available for complex trading by Monday. So essentially, we did this rollout in a week.
That's fantastic.
Yeah, without any problems or technology issues. So, that's a testament to the technology that we used, which is developed by TMX, as well as the development team that we use up there. Usually they were saying that this is the biggest project that Box has ever undertaken in its history, except for when the exchange initially launched. So, this complex order book functionality touched every single aspect and every area of the trading engine. So a lot of effort and work went into it, and we're pretty pleased with the outcome.
Well, it really, our industry is one of intense competition. And this is just the latest example, I think, where, your exchange, and probably due to, the intense competition has moved forward with this, this new complex order book, which is, I'm sure, going to, be well received.
Yeah, we felt that we needed to be able to compete on a more level playing field with some of the other exchanges, and this is one of the, product offerings that we decided to tackle.
And the complex order book can be used by both retail as well as professional or institutional investors. Is that right?
Yep, everybody can use it. One of the unique features of our complex order book is that we have NBBO protection on spreads.
What's NBBO?
NBBO is National Best Bid Offer. So you cannot trade a spread outside of the national best bid or offer, which, spreads are not protected under that NBBO aspect. But this was something that our larger retail brokers asked us to consider doing. And, for us, it was pretty easy, so we just went ahead and did it. And the other thing, too, is we are disseminating implied prices on legs of spreads. The other exchange that does this is the OIC, so just 2 of us are doing that right now, but we're the only one that does the NBBO protection on strategy spreads.
Well, very good.
Yep.
There's another area that I think is synonymous with Box, and that's the PIP. Would you tell our listeners exactly what PIP is and why it's synonymous with Box?
Right. So Box's price improvement process is unique in the sense that we were the first exchange to adopt a price improvement mechanism, and then the other exchanges followed with a flavor of their own. So having the ability for a retail customer to be able to obtain price improvement is something that order flow senders take a look at when reviewing their execution quality standards. So, for example, if I'm a customer and I can get improved on an order with my price being guaranteed no worse than NBBO, why wouldn't I send that order to Box? And just to point out as you know, a highlight, since Box launched in 2004, the price improvement mechanism has saved investors over $425 million. Since 2004.
And is that $425 million through executions at the Box?
Yes. So that money is, you know, it's a significant amount of savings in price improvement that is essentially put right back into the investor's pocket.
Well, you know, that's definitely good.
It's a good number to be able to, you know, say.
It's significant.
Yeah. So from the, you know, that price improvement standpoint, that's, you know, what Box is known for, and that's what we do.
Now, I see that, you know, your exchange lists, I think it's in the neighborhood of 1,500 classes. How do you decide what to list?
Yeah, we do list a little over 1,500 classes. You're correct on that. There's no rocket science to it, if you will. You know, we list names according to volumes, open interest, and generally sometimes we do get participants to asking us if we could take a look at listing a particular security. So there are several factors which come into play. You know, and we also touch base with our liquidity providers, making sure that, you know, they're able to make a market in whatever name, you know, we're going to list.
Okay. And how many liquidity providers, you know, do participate on Box?
We have about 7 active liquidity providers on Box.
Right. Mm-hmm.
You know, and they're classified as market makers / liquidity providers.
Very good. You know, in the broad context of the options industry, do you see, you know, clear skies ahead? Do you see obstacles for the industry? Do you have a perspective on that? Yeah,
so obviously there's challenges in our business, and you're always going to be faced with challenge. The one area that I continue to see being a challenge and that not changing is regulation.
Mm-hmm.
So there's a lot of uncertainty that is coming out of Washington with the policymakers and the Securities and Exchange Commission being able to really be effective in approving market structure changes and the rules that go along with them. This, you know, when I look at it, you know, it used to be a complete, total U.S. market domination. Now it is more of a global economy, and that global economy now is, you know, somewhat in a tumultuous state given all the uncertainty with, you know, economic instability. So given that, anything that is happening overseas or around the world is impacting the U.S. markets. And, you know, from that standpoint, you've got regulation in the U.S., regulation outside of the U.S. that can also be impacting our business, as well as just economic instability. You know, we've been in a low volatility period right now, and trading volumes continue to decrease.
Well, decrease on the underlying side more so than the option side.
Yes,
right?
So exactly what I was going to. It's, you know, from a overall sentiment of the economy, it's not that great. But that's in equity land. But the one bright spot that still continues to see growth is the options industry.
And why do you think that is?
I like to think of it in a couple different ways. One thing that you can attribute to is better education and how to use options effectively. And, that is a testament to organizations like the Options Industry Council, which you and I are both a part of. And people have the tools and the knowledge to be able to understand how to use options to enhance their portfolios. And traditionally, I think probably, state pension plans as well as other large pension plans are looking at diversifying and being able to use options to hedge their portfolios. I think traditionally they haven't gone down that route, whether it be for lack of understanding or just, from tax implications, et cetera. But now options are reaching a broader community, and I just feel that, it's gaining traction. It's getting to people who options have never, been in even a possibility.
So it sounds like you're bullish on the options industry.
Oh, absolutely.
There you go. Well, any other perspectives or things about the box that you'd like to offer before we wrap up, Patty?
Yeah, I would love to tell you about a new product that we are launching.
Talk to me.
That we are launching tomorrow. We're really excited about it. It's a new product we are calling Jumbo SPY, which is a new options contract overlying 1,000 SPY ETF shares per contract as compared to 100 shares per contract for standard options. So we actually received regulatory approval this past Monday, and we'll be launching the product tomorrow. This is a product that has gotten a lot of interest from the institutional and hedge fund community, and we hope it will be successful from an industry standpoint as well as for a box standpoint.
Tell me once again, in case the listeners missed it, exactly what this product represents.
So this product is a 1,000 share settled.
Okay.
On the SPY.
On the SPY. Okay. So the key difference being that it's 10 times the size of your typical options contract.
There you go. It is 10 times the size of the typical options contract. Our industry just launched minis, the mini options,
right,
and they are 1/10 the standard 100 share options contract. So instead of going lower from that regard, we actually went higher on the higher end of the spectrum, I guess.
Well, as you say, that's probably a product not for the typical retail investor, but the pension plans and the institutional types out there. So we certainly wish you a lot of luck with that.
Yeah, you can actually go to our website, www.boxexchange.com, and we have a section on Jumbo SPY with regard to FAQ pricing, and if anybody's looking for a more detailed explanation, they can get it on the website as well.
That's excellent, and that was www.boxexchange.com.
You got it.
Well, Patty, thanks so much for sharing your thoughts on basically your journey through the industry as well as the box and your perspectives on the industry going forward. All the best to you.
Oh, thank you so much. I appreciate it. And again, I really enjoyed it and had a great time.
Well, thanks again for joining us on OIC's Wide World of Options.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In tools, resources, and good reads today, let me briefly discuss a technical indicator which expresses investor sentiment, and that's the put-call ratio. It's an indicator used to determine when investors may be getting too bullish or too bearish. You may consider a position in the other direction when the herd is getting too bullish or too bearish. This put-call ratio is generated by taking the number of puts traded and dividing them by the number of calls traded in either individual issues or indexes over a period of time. The indicator can also be calculated on a dollar-weighted basis. Since investors typically trade more calls than puts, the average value for the ratio is somewhere below 1. A reading below 1 reflects bullish sentiment among investors where they are buying more calls. Readings of 1 or higher indicate a bearish sentiment with more puts being purchased. The put-call ratio is considered a contrary indicator, so with readings of 1 and higher, more or too many puts are being purchased, which means many are bearish. And used as a contrary indicator, this may be alerting a savvy investor to take a position on the other side. The opposite would be true for readings below, say, 0.6 or 0.7 or so, with far more calls being purchased, suggesting the masses are long and therefore a short position may be warranted. This indicator is not a precise type of indicator. It's one that requires research on the part of investors to get familiar with the extreme levels of these ratios for their favorite stock or indexes. That may present an investment opportunity on the opposite side of the masses. The put-call ratio is best used in conjunction with other indicators like MACDs and stochastics, to name a couple. Put-call ratio for indexes are generally higher because fund managers and others often buy puts for portfolio protection, resulting in higher put-call ratios for index options. Again, research or tracking these ratios from sources like the OIC on equities and indexes from each of the exchanges can get one comfortable with the extreme levels of the various put-call ratios. Try the OCC website, www.theocc.com, or again, call Investor Services if you're unable to track it down on the site. And the number for Investor Services is 1-888-OPTIONS. So that's the put-call ratio. I would urge you, if you're looking to add to your toolbox, you might consider that. But make sure you do your homework before you start to trade positions around the ratios themselves. And today's good read I'd like to offer to our listeners is the Options Playbook by Brian Overby. And Brian's with Trade King. Brian does a great job clearly explaining the risk and rewards of many option strategies. Again, that's the Options Playbook by Brian Overby.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we'll feature October 19th, 1987, the famous stock market crash. The market crashed 23%, or 508 points, that Monday in October 1987. There were many explanations why. Computerized trading, does that sound familiar? And a falling U.S. dollar getting no support from the administration are the two that I remember best. The fact is, the market was in the tank, or at least down hard, for probably 7 to 8 weeks leading up to the crash day, down about 17% before that Monday from the highs at the time, which in Dow Jones Industrial terms was about 470 points. Friday, October 16th, the market had a serious sell-off, and fears were high that weekend for a follow-through on Monday. That Sunday night, Secretary of the Treasury at the time, James Baker, made comments that markets interpreted as bearish, the futures got slammed overnight and the rout was on. The last hour and a half of trading that Monday was especially volatile, with the markets closing on their lows at 1738 in the Dow. The VIX didn't exist in 1987, but going back and applying the market movements in that period would have created a VIX level of 150. As a comparison, the VIX topped out at 80 in November 2008 in our recent financial crisis. We remember how incredibly difficult that recent financial crisis was. VIX topping out at 80 versus 150 in 1987 gives you a sense of the magnitude of the crash of 1987. A few more points. Bonds traded locked limit up all week following October 19th. Monday, October 20th, brought on the greatest rally ever in the Dow Jones Industrial Average at that time. The Federal Reserve played a large part in the rally on the 20th. Again, does that sound familiar? Assuring world markets they would be adding liquidity to the marketplace. My recollection is the Fed urged many U.S. companies to immediately announce share buyback programs bolstering the markets. The crash of '87 was not a one-day event. The market had been selling off for weeks leading up to the day of the crash. And looking back, the market gave willing investors an opportunity to buy stocks on sale in what turned out to be a classic V bottom. That's a technical chart formation where the market sells off hard on enormous volume, then rallies hard off that market bottom to form a V on the charts. One last note, Hollywood's Wall Street with Michael Douglas and Gordon Gekko was released in October 1987. Does anyone remember Greed is Good? That's it for today's show. Join us next time on OIC's Wide World of Options.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.